My friends, this better be the best episode you've ever seen because this is not the third but the fourth time I've done this because I keep screwing up someplace. We're going to talk about community property taxes and how big of a deal they are. And if you don't think there's such a deal in a community property versus common law state, man, you are wrong. And we're going to unwrong you here today because I'm going to show you a real world with Jane and Bob YouTube example of how the taxes on non-community property versus or common law property versus community property is such a big difference. So let's dive right into it here. If you like what you see here at Heritage Wealth Planning, we talk about taxes and how to reduce your taxes, if not eliminate them outright, and just how to get your financial planning in order. So don't forget to subscribe. All right, let's go down here and run this again. I love this stuff. I love the tax code because tax code is complex, but once you see it, you start saying, "Oh, I see a way I can benefit from that." People call them loopholes. It's not loopholes; they're for everyone to see. Just got to read the doggone thing. All right, so let's go right when we cancel this guy. So remember, we had Bob and Jane YouTube. All right, so we had Bob. He was 4 years older than Jane, and they had Social Security as their only source of income. They each had $250,000 in a Vanguard Total Stock Fund. Bob died at, we had him dying at 80 years old, so that's where I have him down at 80 now. And what happens then is Jane will lose the lesser of the two Social Securities. All right, so Jane's going to retain hers and lose Bob's, or retain Bob's and lose hers. Either way, it doesn't matter. She's going to lose one and retain the other. The lesser, she'll lose the lesser. Now, they only had $3,000 a month of expenses. So initially, the Social Security was enough to cover their expenses, so they did not have to tap into their investments. But we have expenses inflated at 3% a year and Social Security only at 2.6. So at some point down the road, the expenses overtook Social Security, and they had to start selling stuff from the portfolio. Let me plug this in order to make ends meet. Now, when Bob and Jane were married filing jointly, they didn't have to pay any taxes whatsoever because even when they sold stuff, because they're still in the 12% tax bracket, there is no capital gain tax, none whatsoever. And so, as I showed you in a couple other videos before, the difference between ETFs and mutual funds with no capital gain tax, they had no tax, all right? Even though they had significant amount of income coming in because of Social Security, capital gains, qualified dividends, because they still stayed in the 12% bracket, there was no tax due whatsoever. Maybe a little bit, like $1,000 on the worst year that they had. Then all of a sudden, Bob dies, and boom, huge taxes to Miss Jane. Why? Because she inherits Bob's part of the investment that they have. So in the investment that they have, we'll show you right here. The investment that they have is they each, well, you can't really see that right there. So basically they each had $250,000 to start off in a Vanguard Total Stock Market Index, and it grew to whatever 1.17 divided by 1.157 divided by 2. It grew to $578,000 each. Right, so they each had $578,000 in Vanguard Total Stock Index when Bob died. Now, under common law state, Bob's 578 goes to Jane, and that is completely tax-free because of the step up in basis. So Jane has this amount of money, but only half of that is tax-free. The other half is taxed as long-term capital gain. So when Jane starts selling stuff to cover her expenses, she had to pay tax on that because of the unrealized gain she had for capital gain. Now, some would argue, Josh, that's kind of disingenuous because Jane can do specific identification in which she can identify individual shares. That's 100% right. And hopefully she does that. A lot of time, the brokerage houses will just do average shares, which means a part will be of the capital gain will be tax-free due to return of principal, and a part will be unrealized gain, which is horrific, but that happens all the time. So I'm just using you as a simple example here. You can slice and dice this any way you want. But what I want to show you now is, in a community property state, Jane inherits not just Bob's side of the account with 100% step up in basis, but she inherits her own as well. So that means its entirety, $1.157 million, is completely tax-free from a capital gain perspective because that is now her cost basis. Common law state, only half of that goes to her cost basis when Bob dies. A community property state, the entire amount goes to her cost basis when Bob dies. So if she sold this entire thing today, she'd have no income tax whatsoever. None. If she sold that entire thing today in a common law state, she'd pay capital gain tax on $578,000, which would be subject to net investment income tax and the 20% capital gain as well. Never mind taxing the heck out of everything else she has. Never mind her Medicare premiums. Never mind all the other stuff. So I'm just telling you, it's amazing the community property benefit that is there. What do you need to know? If you move from Texas to New Hampshire and you got community property, literally community property in Texas, and you retitle that as joint tenants with rights to survivorship or tenants by the entirety or tenants in common, you're wrong. Don't do that because you've just ruined that community property that you had. You can move from community property to common law estate, and retain the community property of that various piece of property that you own. You can. Now, each state is different, but this is from the federal taxation anyway. So you can do that and still retain the community property. Now, if you move from common law to community property, it's a little bit different. But just remember, if you move from point A, Texas, California, Idaho, to a common law state, you got to understand how your property is titled now before you start retitling it. You could make a huge mistake. If you move from common law to community property, I just leave that for you to talk to a competent tax advisor, probably a competent legal person, because they can tell you about the titling of assets in your very state you're relocating to. This is another reason why people say you don't need an advisor, just do it your own. I guarantee you the vast majority of people do not know the difference between community property and common law. And because of that, they're going to leave themselves open to paying taxes on $578,000 that they didn't have to pay tax. So let me just show you. Let's just go right into it. I'm going to show you it now. So Jane now receives, we're going to go to cash flows. Jane now receives the entirety of the portfolio completely with cost basis. There's 100% step up in basis on the entire amount, her amount and Bob's amount. Common law, it'll only be a Bob. So I just cannot stress how beneficial that is. Now, she still has a little bit of tax. So here's her income. That's her Social Security that she retains. She loses one. Still has expenses. We probably should have made that a little bit higher because we're just using expenses as if that were her today. It frankly doesn't matter. I really don't care about the expenses. I'm just looking at the taxes. So what happens here is when she has to make a sale of a property to cover the expenses that she needs right here, she would have to sell it, and there would be a capital gain, but it would not be taxed. Now watch. Now she still has tax payments here, and you might wonder what that's about. So let's go into, I tell you what, let's do this. I'm going to show you something actually. Let me change something around here. I want to change something around to say her Social Security, her expenses are going to be higher. We're going to make her expenses, because I want to show you her retirement expenses, because they are going to be, where we got, is that pre-retirement expenses? We want goals. Yeah, here we go. We want retirement expenses. We're going to say they're $5,000 a month, because I want her to have to sell some stuff to get a capital gain. To start selling some of her assets so you can see how the capital gain will work. All right, so let's go to retirement. We're going to go to cash flow. Watch this. All right, so now she has $38,000 coming in, but she has $60,000 going out the door. $39,000 coming in, $61,500 going out the door. So she has net cash flows negative $21,022. So she has to sell stuff from that portfolio of $1.157 million, whatever it was, to cover the deficit there. Ironically, no tax payments. No tax payments. Why would that be? Now, she does have a little bit of tax payments down here, so let's dive into that. But why is there no tax payments when she has to sell stuff for $21,000? That's $100,000 right there she had to sell. There's another $100,000. So she sold, what's that, almost $200,000 and hardly any tax payments at all. So let's take a look at the old tax form here on this page. So let's go to the details. Look at the 1099. And this is for her first year without Bob. She's a widow now. So she has $20,000 of ordinary dividends. And you can see she has a $1,300 capital gain, not much. And that's just because we have it growing at 7.5% a year. So she is going to have to sell it. Again, we could do specific identification to make sure that doesn't affect her. But at the end of the day, we're going to say we're just going to keep it simple, that she had a small capital gain because of the growth of the portfolio, the nominal growth of 7.5% a year. She has Social Security benefit, but none of that's taxable. None of that Social Security benefit is taxable. Why? Because only This right here is part of her provisional income. And if your provisional income, remember, is below, if you're single, 25,000, which it certainly is, guess what? None of your Social Security is taxable. So her provisional income is below 25,000. None of her Social Security is taxable. And now if we see here, she has taxable income 8,797. But we know we don't have taxable income of 8,797 because the taxable income consists of part of her dividends and that tiny little capital gain. If we take back the qualified dividends and capital gain worksheet, what flows to line 44 in the tax code is zero, even though it looks like she should have to pay taxes on $8,797. I know it's confusing, but you got to understand the tax code. She owes nothing, my friends, nothing, even though she has taxable income. And again, the reason that is her Social Security is not taxed. It's just that simple. All right, so let's go fast forward a little bit. And we're going to go to 2024. I'm just pulling something out of the air. Now she's got a little bit more capital gain. Again, she really wouldn't have any capital gain whatsoever. But remember, she had huge capital gains here when Bob died and she inherited the property. Huge capital gain because she only got half of the step up in basis. And we're talking $30,000, $40,000 of capital gains to make up the deficit, the difference between how much she had coming in, how much she needed. And she got that from selling property. Now she still has, and we're only talking 2% dividend payout, but 2% on a 1.3 million is real money. That's $24,000. And so that's taxable. That's taxable as qualified. The difference between these two is taxable as non-qualified dividends. Capital gain will be subject potentially to taxation. 43,000 Social Security, only 4,500 is taxable. So now we go down here. She has taxable income of line 43 of $26,000, but again, she owes no taxes because we have the qualified dividend tax and capital gain worksheet, and she owes nothing to the man. So even though she has capital gains and dividends and Social Security, she owes nothing because she hasn't had to sell big capital gain property, which would be subject to taxation like we did have to when she lived in the common law estate. Community property, everything steps up, which means you have minimal to zero capital gain in the future. All right, so let's fast forward a little bit. And I forgot when she died in 2031. So now we go to 2029. The years aren't going to correspond in this video with the previous ones I've done just because I don't know how to actually forward this and have Bob die at any given day. So I'm just saying at the end of the day, we're starting the scenario with Jane being a widow at the year of 2019. All right, so now we got $29,000 of dividends, of which 25 is from qualified dividends, which is taxed more favorably. 14,000 of capital gain. 50,000 roughly is Social Security, of which 20,000 is taxable. She has 76,000 of income at the IRSCs, and we go down here and she pays $6,287 of taxes. Again, pretty minimal. That's roughly the 10%. I mean, look at that, a little bit more than 10%, but it's not much. And the only reason for that is because this is taxed more preferably than the difference between these two. That's going to be taxed at 15%. A portion of this will be taxed at 15%. And then the rest would be taxed at whatever bracket is, which is 12%. So this would be taxed at 12. The good amount of these won't be taxed at all, and the rest will be taxed at 15. And so here she has, that's her taxable income, 61,000. The vast majority won't be taxed, and anything left is taxed at 10% when all is said and done, her effective tax rate. So now finally, let's go to her flat. And the only reason she even has this amount of tax right here anyways, because she has such a large dividends, and she got, again, 2% as her dividend percentage. So every year, $1 million portfolio is giving you $20,000 of dividends. So if she has $29,000 of dividends, we know that portfolio is $1.5 million at 2%. That is taxable income, but she's still making $30,000, $45,000. That's $95,000, and she's paying $6,000 of tax on $95,000. I mean, I'm not crying over spilled milk there. That's not too shabby. All right, this is her last year, and you can see now her dividends are $31,000. Capital gain is still a pretty minute, or is that the right word? Small, $20,000. Social Security is 52. Taxable Social Security is not even close to the 85% max. So she has $103,000 of seen income from the IRS. You got to add the difference between this and that, which is another 21,000. So she has basically 125 of income, of which $12,000 is taxed. Again, that's a lot more than I'd like, and the reason is for this right here, the large dividends. You can't do anything about that when it comes to step up in basis. But the facts are, at the end of the day, She started this account, her and her husband Bob, $500,000. Not a penny was subject had any cost basis. So there's no cost basis at all. And yet at the end of the day, this thing is worth with 31,000. 679 divided by 0.02. That thing's worth $1.6 million. And all she has to even declare as capital gain, not pay tax on it, just declare as $20,000. So we take $20,000 divided by 1.6 million. Her cap, that's a 1.2%. She's only the turnover, 1.25%, not really turnover, but that's the capital gain distribution on that portfolio of $1.6 million. That's nothing. In fact, again, at the end of the day, if she had an ETF, it wouldn't be anything anyway. And then she wouldn't have to, or she'd have a specific identification on the shares she would sell, so I could easily eliminate it with just some basic tax planning. We want to sell those shares and not those shares, i.e. no taxes due. Folks, understand community property rules. Again, the community property states are Idaho, California, Washington, Wisconsin, Texas, Arizona, New Mexico. It's Colorado. I don't think Colorado was. I'm most positive Colorado was not. Nevada, maybe. There's 6 states out there plus Texas and Wisconsin. If you have any domicile in those states and you don't know, and you're moving someplace else, or you're not sure exactly how you should title your assets, you need to see an attorney. There's just no other way around that. Pay the $1,000 to see an attorney, because you're going to save, in this case, she's going to save over $100,000 in taxes easily. In fact, I'd even argue more, simply because of knowledge and use of the tax code. All right, my friends, community property states, understand it, live it, love it, and then to pass it on. I hope you enjoyed this. I love this stuff, and we'll do more taxes later on. But again, if you like what you see, subscribe. Comments help me with the YouTube algorithms. So comment away, fire away. Anything nasty, I'll delete. But constructive criticism is fine. You yab too much or whatever, that's fine. Don't care. And then just comments are fine. Thumbs up. Share this stuff, man. If you like what you see, or share it on Facebook, share it with your friends. The whole thing is appreciated. Look at the new website, heritagewealthplanning.com. Everything's been updated, so I love it. So just go there as well. And we'll see you next time. Thanks, guys.